Gold is at an all-time high, but here's the question nobody's asking. Is it headed for a crash in 2026? The rise in gold prices looks unstoppable, right? But could it be about to take a sharp dive? You've heard the stories, prices surging to record levels, but what if this is the calm before the storm? Stick around because I'm about to show you why this gold rush might be much more fragile than it seems. Now let's zoom out and look at the bigger picture. In 2025, gold skyrocketed by 64%. To put that into perspective, the S&P 500 only gained 16% that same year. Gold wasn't just soaring in numbers, it was outpacing nearly everything. But here's the twist. Take a closer look and you'll see something unsettling. On the surface, the price rise seems steady, even stable. But when you pull back and look at the 30-year chart, it tells a very different story. It starts to look almost too good to be true. Could we be on the verge of a correction, or is gold just getting started? Here's the thing. History has a way of repeating itself, especially when it comes to gold. Take a look at the 50-year chart. The most infamous gold crash happened in 1980. Gold had been climbing steadily through the 1970s, driven by runaway inflation, oil shocks, and a crumbling confidence in the US dollar. But when gold hit $850 per ounce in January 1980, it plummeted by 65%. So why did it crash? It wasn't because gold was too expensive. It collapsed when people regained faith in the US dollar. That's the key. Gold doesn't fall just because it gets pricey. It falls when confidence in paper money is restored, and that's something most people miss. But why did this happen? Let's break it down. So what caused the collapse back in 1980? It wasn't just inflation, it was credibility. The public had lost faith in the dollar. The Federal Reserve wasn't seen as doing enough to control inflation. But then, in a game-changing move, the Fed, under Paul Volcker, raised interest rates to 20%. Can you imagine that? Interest rates higher than 20%. Just think about the impact. It wasn't just a small adjustment. It was a full-force correction. People who had been hiding their money in gold for safety suddenly found that cash was no longer losing value. Real interest rates went positive, and that shift almost overnight changed everything. Gold, it didn't stand a chance. But here's the catch. Today, we're nowhere near those levels. The Fed's current rate is still under 4%. That's a world of difference. Now let's talk about the real kicker. Gold didn't fall because it became too expensive. It fell because its role was no longer necessary. In the 1980s, people turned to gold as a safe haven when the dollar's value was in question. But once confidence in the dollar was restored, gold lost its appeal. Fast forward to 2011, gold once again hit record highs, reaching nearly $1,120 per ounce. This time, it was after the global financial crisis, with the Fed pumping money into the system through quantitative easing. Yet once again, gold didn't stay on top. It peaked and then fell. But here's the difference. It wasn't because gold had become overpriced. It fell because the need for it as insurance vanished. The economy stabilized, real interest rates started rising, and people moved back into risk assets. Gold entered a slow, grinding decline over the next few years, losing almost half its value by 2015. So why didn't it crash right away? There was no singular event. It was just the slow return of confidence in other assets. And here's where it gets intense. Now, we're seeing multiple things happening all at once. Inflation is still stubbornly high, and the Fed's interest rates, though rising, are nowhere near what we saw in the 1980s. But the situation is worsening on multiple fronts. The U.S. government's debt is out of control, over 120% of GDP. The deficit keeps growing, and fiscal policy remains loose. What happens when all this pressure builds up? The dollar becomes weaker, and confidence in the system starts to crack. Meanwhile, central banks around the world are buying gold at record levels, seeking to hedge against a collapsing dollar. This is creating a persistent baseline demand for gold that wasn't there during past peaks. Now ask yourself, what happens if this continues? If the dollar weakens further and the U.S. continues its reckless spending, gold will have no choice but to respond. And if the dollar begins to lose its grip as the global reserve currency, the implications are far-reaching. Gold may be more insulated from a crash than it's ever been before. Now let's shift gears and talk about what this really means for you. Forget the charts for a second. Let's get personal. Gold is often seen as a hedge, a safe place to put your money when everything else feels risky. But here's the real question. What happens to ordinary people when gold prices surge like this? The cost of living is rising. Inflation is hitting your wallet every day, and people are struggling to keep up. The dollar isn't stretching as far as it used to, and even if you're not directly invested in gold, you're feeling the effects. If gold crashes, it's not just the wealthy who are impacted. Everyone's financial future is on the line. So let's be honest. If this feels familiar, if you felt the squeeze of rising prices, drop a comment below. We're all in this together, and the future is uncertain for all of us. But here's where it gets even more unsettling. The truth is, gold's rise or fall isn't just about inflation or interest rates. It's about the system itself. You see, gold is just a symptom of a deeper issue. It's about trust. Trust in the dollar, in our financial system, and in the promises that governments make. When gold is soaring, it's because people are losing faith in the value of fiat currency. And that trust isn't something that can be rebuilt with just words. It takes real hard action. The system is built on leverage, spectacle, and fear. But here's the kicker. When people stop believing in the system, they turn to gold. They turn to something tangible, something that can't be printed on a whim. But as long as the government can print unlimited money, they'll keep doing it. The question is, how long before people stop believing in the game altogether? Now, looking ahead, there are two paths we could be heading down. On one hand, we could see a continuation of the current gold bull market, but with sharp corrections along the way. It's not uncommon for gold to dip 10–15% before rebounding higher. This would mean volatility, but it wouldn't signal a collapse. On the other hand, there's a darker possibility. Gold could enter a full-blown bear market. But let's be real. This would require drastic policy changes that aren't exactly compatible with today's financial realities. With the U.S. government's massive debt, the Fed's limited tools, and the world's shift away from the dollar, it's hard to imagine that kind of sudden policy shift. The reality is, gold's path forward is uncertain, but it's clear that the momentum is building. Whatever happens next, the next move is already starting to take shape. So what's the bottom line? Gold isn't just a commodity, it's a mirror to the global financial system. It rises when confidence in the dollar falls, and it falls when that confidence is restored. But the critical thing to understand is that today's environment is unlike anything we've seen in the past. Gold doesn't just rise because it's too expensive. It rises because people are seeking refuge from something bigger, a loss of trust in the system itself. Will that trust be restored? Can the U.S. dollar hold its ground in the face of growing debt and inflation? The future remains uncertain, but one thing's clear. Gold will continue to play a key role in this unfolding drama. So if you want to stay ahead of the curve, keep an eye on these key factors. And if you want to see what I'm doing with my own gold investments, head over to my Patreon for exclusive content. Thanks for watching, and don't forget to subscribe for more insights. We're just getting started.